Venture capital is inherently a high-risk asset class where a small percentage of investments drive the majority of returns. To maximize the chances of backing winning startups while managing downside risk, VCs rely on diversification strategies across different dimensions: investment stage, industry sector, and geographic region. Diversification is not just about spreading bets randomly, it is about thoughtful portfolio construction that balances risk, upside potential, and capital allocation. A well-diversified venture fund can withstand market fluctuations, capitalize on emerging opportunities, and deliver more consistent returns to LPs over time. Venture investing unfolds across multiple stages, each carrying distinct risk-reward profiles. Funds must decide whether to concentrate on a specific phase or diversify across a startup's lifecycle to optimize returns and mitigate risk. Early-stage investing, like pre-seed, seed, Series A, represents the highest risk, but also the greatest potential for outsized returns. Startups at this stage are still proving their concepts, developing products, and searching for product-market fit. Valuations are lower, allowing investors to secure larger ownership stakes with relatively small investments. However, success rates are low, and hands-on support is often required. The typical exit horizon for early-stage investments ranges from 7 to 10 years. Growth-stage investing, as Series B, C, and beyond, focuses on startups with validated business models and growing revenues. While valuations are higher and ownership stakes smaller, the failure rate is significantly lower compared to early-stage companies. These investments require larger checks and deeper follow-on reserves, but offer a more predictable scaling trajectory. Exit timelines typically fall within 4 to 7 years. Late-stage and pre-IPO investing targets companies that are on the brink of liquidity events, such as an IPO or acquisition. These investments carry lower risk, but also less upside potential than earlier-stage deals. The priority shifts from rapid growth to profitability and exit readiness, with a timeline of 1 to 3 years. Some funds adopt a focused strategy, specializing in one particular stage. For example, Y Combinator operates strictly in the early-stage space, investing in startups before handing them off to later-stage investors. In contrast, firms like Sequoia Capital pursue a multi-stage strategy, backing startups early and continuing to invest as they scale. A hybrid investment approach might allocate 40% of capital to early-stage deals that are high-risk, high-return, 40% to growth-stage investments, which are moderate risk, strong scaling potential, and 20% reserved for late-stage or follow-on funding that is lower risk, faster liquidity. This balanced structure enables funds to capture early-stage upside while ensuring stability and cash flow from later-stage exits. Venture capital thrives on megatrends, industries evolving rapidly due to technology, regulation, and shifting market demand. Some funds specialize in specific verticals like fintech or biotech, while others diversify across multiple sectors to reduce risk and capture emerging opportunities. Technology-driven sectors such as SaaS, AI, cybersecurity, and cloud computing offer high scalability and recurring revenue models, making them attractive for venture investment. These sectors tend to experience steady growth, benefiting from digital transformation across industries. Healthcare and biotech require deep industry knowledge due to long research and development cycles, regulatory hurdles, and capital-intensive development. Biopharmaceuticals, medical devices, and health tech platforms often yield high returns, but timelines are longer compared to software-based startups. Fintech and crypto continue to disrupt traditional financial services with innovations in payments, lending, and blockchain-based infrastructure. However, these sectors are heavily influenced by regulatory changes, requiring funds to carefully navigate legal landscapes. Climate tech and sustainability investments, including renewable energy, carbon capture, and electric vehicles, align with ESG mandates and benefit from policy incentives. While capital-intensive, these sectors are becoming a priority for institutional investors looking for sustainable impact. Consumer and marketplaces include direct-to-consumer brands, e-commerce platforms, and social media-driven business models. These startups rely on strong branding and efficient unit economics, making them sensitive to economic cycles and shifting consumer behavior. A diversified sector approach protects against downturns in any single industry. For example, During economic recessions, consumer startups may struggle while enterprise SaaS and biotech firms continue to perform well. Venture capital has traditionally been concentrated in a few key hubs like Silicon Valley, New York, London, and Beijing. However, the rise of remote work, distributed talent pools, and new startup ecosystems has made geographic diversification an essential part of fund strategy. Investors are increasingly looking beyond these traditional markets to find new opportunities and mitigate risks. The US remains the largest venture market, offering a mature startup ecosystem, deep capital pools, and access to world-class talent. However, competition is fierce and valuations can be aggressive. Europe, on the other hand, has become a strong contender, particularly in fintech, AI, and deep tech. With increasing government support for innovation and a growing VC scene, it presents a compelling alternative, often with less inflated valuations compared to the US. Asia tells a different story. While China's venture market is massive, it operates under heavy regulations, requiring a more cautious approach. Meanwhile, India and Southeast Asia are emerging as high-growth regions, offering lower capital requirements and significant market potential. Similarly, Latin America and Africa present exciting opportunities, particularly in sectors like fintech, mobility, and logistics. These regions are high risk, but for funds willing to navigate the challenges, the potential for massive returns is undeniable. Geographic diversification isn't just about chasing new markets, it's about risk management. When the US market corrected in 2022, funds with exposure to India and Latin America continued to see strong growth, while those concentrated solely in Silicon Valley faced sharp valuation declines. A balanced approach might involve allocating the majority of capital, around 50 to 70%, to core markets like the US or Europe, with 20 to 30% directed toward high-growth emerging markets such as India or Latin America. The remaining 10 to 20% could be reserved for strategic bets in specialized regions like Israel for cybersecurity or China for AI. Expanding globally isn't without its challenges. Investing in new regions requires an understanding of local markets, regulatory landscapes, and cultural nuances. Many firms mitigate these risks by partnering with local VCs, gaining access to better deal flow and on-the-ground expertise. While venturing beyond traditional hubs demands effort and adaptability, it ultimately strengthens a fund's resilience and positions it for long-term success in an increasingly global startup ecosystem. A well-structured VC fund balances its exposure across stage, sector, and geography to create a portfolio that can withstand economic downturns, seize high-growth opportunities, and deliver steady long-term returns. For instance, a $200 million diversified VC fund might allocate its portfolio by investing across different stages, with a mix of early stage, growth stage, and late stage startups. Sector diversification could focus on core expertise areas like SaaS and fintech, while also incorporating emerging technologies such as AI and space, alongside a portion dedicated to contrarian bets. Geographically, the portfolio might lean heavily toward North America, with allocations in Europe, India, and Latin America to capture growth in different regions. By maintaining a diversified mix of investments, the fund maximizes its ability to adapt to market shifts, mitigate risks, and capitalize on global innovation trends. Diversification does not eliminate risk entirely. Venture capital remains a high-risk, high-reward game. However, thoughtfully balancing exposure across multiple dimensions increases the likelihood of achieving strong, consistent returns over time. In venture capital, a single winning investment can define an entire portfolio, but a well-diversified strategy ensures that multiple paths lead to success. Venture capital firms mitigate risk and optimize returns by diversifying investments across startup stages, industries, and geographies. A balanced approach combines high-risk, high-reward early-stage bets with more stable growth and late-stage investments, ensuring liquidity and sustained returns. Sector diversification spreads risk across thriving industries, while global exposure captures emerging market growth. A resilient VC portfolio isn't just about spreading bets, it's about strategically allocating capital to maximize long-term success in a volatile, high-stakes asset class.